Welcome back to Investment 360. We are back with Stephen Meintjes from Imara SP Reid and looking at stock picks for October. And of course, my co-hosts, Giokos from First Avenue Investment Management and Vickers Murray from Stratasys are still here. There's a stock on the JSE that has exceeded analyst expectations. Some people love it and other people hate it because they didn't get the story right. Capitec, you are, of course, quite interested in the stock. We know that you've been in it before, sold and bought back many times. Where do you stand right now?
Now we have what's called an ad that's a little bit less than a buy recommendation. In other words, we're suggesting that investors don't have it, they get some, leave room to get some more later. We do think that they are quite serious about continuing to grow market share. And we know the other banks are giving their full attention to the situation, but I think these chaps have got the inside curve and will continue to gain share.
But there's this notion that it's looking slightly expensive and many people are wondering whether it can continue this kind of double-digit growth going forward. Do you think that is a real concern?
Well, they'll easily do double-digit, but maybe not 40-50%.
Yeah.
But you know, anything in the sort of 20s and 30s, I think you can justify this kind of PE.
Clelo, are you kicking yourself or are you smiling?
Well, I'm one of those people who I just had to forget that it exists on the stock market, because I missed it. The question is always, what kind of rate of growth do you need to assume for this company to look cheap? So if you take PEs, what kind of growth do you have to assume for the PE to unwind to a reasonable number? So what do you think, using very naively PE, what PE do you think is fair for it?
Well, I think one works on what used to be a boom time measure, a PEG ratio for genuine growth stocks. As long as it's not more than 1. And in other words, if its growth rate is, if its 3-year forward growth is over in excess of the PE. So, I mean, you can easily justify a PE in the teens or even higher on that basis.
Because you're sitting there quietly. Have you missed it? Are you smiling?
I wasn't exposed nearly enough to Capitec, but I think Capitec is a fantastically managed business, and I think they've done some things that the other banks will just not be able to do as well as they're doing it. So I think that's a good story, but I don't like highly valued stocks in principle. I would much rather go for more pedestrian stocks that are at much more reasonable P's. And I personally think that if we look at the banking sector, you've basically got Capitec and virtually nothing else. Whereas it seems to me that the banks have been growing, the other big banks have been growing their earnings quite nicely without actually growing their books much. As soon as we actually get a real upswing in the economy, aren't these banks going to do really, really well, the other banks?
Yes, we've got some banks, a little bit of banking in disguise with Remgro holding, but so that's a little bit of banking there. And then we've got quite a nice position in First Rand, which is still good despite today's disappointment.
Yeah. Stephen, your spec buys, Coal of Africa and Petman. Why?
Well, Coal of Africa has got some very good assets. It's bought some coal assets in Limpopo from Rio Tinto for a song as Rio Tinto was sort of exiting. And they've got the environmental license for the Mapungubwe, the Vele mine near Mapungubwe, and they're just waiting for the water license. Now, if they get the water license, then of course they can go full steam ahead at Vele and start making money from next year sometime, because they're already very close to getting up and running. And I think everything hangs on that water license. I think that is why the stock is being hammered. People don't understand this. It's
down 6.8%.
Yes,
today.
I think that can. I suspect maybe some of the Australians are selling it because it's of Australian origin, shall we say, and listed there as well.
Petman and Coal of Africa too risky for you, Vickers?
I think that the guys at Coal of Africa wouldn't have gone to all the trouble and basically put the operations in place if they weren't confident of the water license. So I think you're right. I mean, hold a little bit of it and see whether the water license comes. But I think that you should do this in small quantities in your portfolio.
Construction, Basil Reid and Avenge. You've got ads a little less than actual buy, and Murray and Roberts a hold.
Yes, well, I think Murray and Roberts is inherently very, very sound. They are managing to get some of the money back. I think we really just want to see a little bit more progress first. We're more confident on Basil Reid, which has got some good turnaround potential on the engineering side, and the mining side is doing well. and Avenge is the big one.
If I may just ask, Masonite, isn't the free float there very small? Isn't it like 8% or so?
Yes, yes.
So how do you even research a company like that which you know that you're not going to be able to buy?
Well, we do cater for private clients, and so we do give them little ones to look at, and that is a special case. It's just one of our analysts happens to like it, and so we indulge him in that.
Fantastic, gentlemen. We have to leave it there. Thank you so very much for joining us this evening. That was Stephen Meintjes from Imara SP Reid, and of course a big thank you to my co-host Giokos from First Avenue Investment Management and Giokos from Stratasys.